Okay, so someone hands you a data center. Not a server in your closet, the real thing. A windowless building the size of several football fields, humming with tens of thousands of machines, racks stacked floor to ceiling, blinking lights running 24 hours a day, 7 days a week, powering everything from your bank's mobile app to the AI model answering someone's question on the other side of the planet. Every major company on Earth needs this. Demand for computing power has never gone down in the history of the internet. You just plug in the machines, sign the leases, and let the digital economy pay you rent forever. It is not that simple. Owning a data center is one of the most capital-intensive, fastest depreciating, and most infrastructure-dependent businesses that exists, and the demand story that sounds bulletproof today has looked exactly as bulletproof before, right before an entire industry built too much, too fast, and collapsed under its own construction debt. There are data center operators generating extraordinary, highly predictable cash flow for decades at a time. And there are data center companies that raised billions of dollars during a boom, built out enormous capacity nobody actually needed yet, and went bankrupt within a couple of years once the hype outran the real demand. Here's the thing about this business. The building itself is almost the least interesting part of the economics. Let's be clear about what you're actually buying, because data center describes several very different businesses layered on top of each other. A hyperscale data center is a facility built and operated by one of the giant cloud companies, Amazon, Microsoft, Google, Meta, exclusively for their own internal use, running their own cloud services and their own AI training clusters. A colocation data center is a different model entirely. A building where the operator owns the physical space, power, and cooling infrastructure, and rents out server racks or entire private suites to other companies who bring in their own equipment, essentially a landlord renting shelf space for computers instead of office space for desks. A wholesale data center sits somewhere in between, leasing enormous dedicated blocks of space and power directly to a single large tenant, often one of those same hyperscale cloud companies, under a long-term contract. And an edge data center is a small, distributed facility placed close to end users specifically to reduce latency, more of a network of tiny outposts than one giant building. This script focuses mainly on the colocation and wholesale model, the version most private investors and companies actually build and operate, because the hyperscalers mostly build for themselves and rarely sell that capacity to anyone else. Let's talk about what it actually costs to build one. A large modern data center campus today runs somewhere between $1 and $2 billion for a major facility, and that number has climbed sharply over just the past few years as the industry has shifted toward AI workloads that consume dramatically more power per rack than traditional cloud computing ever did. And here's the detail that surprises almost everyone outside the industry. The building itself, the concrete shell, the steel, the construction, is often the cheapest part of the whole project. According to industry cost breakdowns, the physical building might represent somewhere around 10 to 20% of total project cost. The rest, the servers, networking equipment, cooling systems, and electrical infrastructure, makes up the overwhelming majority of the spend. You're not really building a warehouse. You're building an enormous, purpose-built power and cooling system with a warehouse wrapped around it to keep the weather out. Before a single server gets installed, you need power. And this has become the single most important word in the entire industry. A large data center campus can require anywhere from 50 to several hundred megawatts of continuous electrical capacity, roughly comparable to the power draw of a small city. Getting that much power connected to a specific piece of land requires negotiating directly with the local utility, and in many of the hottest markets in the country right now, Northern Virginia in particular, the queue to get a new large power interconnection approved can run 3 to 5 years, sometimes longer, because the utility's own grid infrastructure simply wasn't built to handle this much new demand this quickly. Companies are now paying to build their own on-site power generation, gas turbines, and in some cases exploring dedicated nuclear power agreements, specifically to skip that interconnection queue entirely. This is the same dynamic we covered in the nuclear power video in this series, and it's not a coincidence that the two industries are increasingly tied together directly through long-term power purchase agreements. Here's a cost that surprises people even more than power. Water. Traditional cooling systems in many data centers rely on evaporative cooling, which consumes enormous quantities of fresh water, sometimes millions of gallons per day at a single large facility. In water-stressed regions, this has become a genuine point of local political friction, with communities pushing back against new facilities over concerns about competing with residential and agricultural water use. Some newer facilities have shifted to closed-loop or air-based cooling systems specifically to avoid this exposure, but those systems typically cost more to build and can be less efficient in hot climates, which means every operator is making a real trade-off between water cost, energy cost, and local political risk depending on where they choose to build. Then there's cooling itself, separate from the water question. Modern high-density server racks, especially the ones running AI chips, generate so much heat that traditional air conditioning can no longer keep up, which is why the industry has been rapidly shifting toward liquid cooling systems that pipe coolant directly to the chips themselves. Retrofitting an existing facility for liquid cooling, or building one designed for it from scratch, adds tens of millions of dollars to a project before a single customer moves in. And here's a detail that connects directly back to that hardware refresh problem we'll get to shortly. A facility designed around one generation of chip cooling requirements can become partially obsolete within just a few years if the next generation of processors runs even hotter, which is exactly what's been happening as AI chips have scaled up their power draw generation over generation far faster than traditional cloud server chips ever did. Now let's talk about what it costs to run the thing every single day, because a data center's operating costs look completely different from almost any other business in this series. Electricity is, by a wide margin, the largest recurring expense, and the industry measures efficiency using a metric called power usage effectiveness, or PUE, which compares the total power the facility consumes against the power actually delivered to the servers doing useful work. A poorly designed older facility might run a PUE of 2.0, meaning it burns as much power cooling and supporting the building as the servers themselves use. A modern, well-optimized facility can push that number down close to 1.1, and that difference, at the scale of tens of megawatts running continuously, translates into millions of dollars of electricity cost every single year. Then there's the equipment refresh cycle, which is unlike almost any other physical asset covered in this series. A building lasts decades. Servers do not. The useful life of server hardware is typically somewhere around 3 to 5 years before it becomes economically obsolete compared to newer, more efficient chips, which means a data center operator isn't just maintaining a building, they are running a continuous, extremely expensive hardware replacement cycle for the entire life of the facility. Add staffing, which is surprisingly light compared to other capital-intensive businesses in this series, because modern data centers run largely unmanned, with automated monitoring systems and a relatively small team of technicians handling physical maintenance and security. Add property taxes, which in some jurisdictions are specifically reduced or waived through economic development incentives, because local governments compete aggressively to attract these facilities for the jobs and tax base they eventually bring, even though the direct employment numbers at any single facility are often smaller than people expect. That tax incentive point deserves its own explanation, because it's become one of the more politically contentious parts of this industry. States and counties routinely offer decades-long property tax abatements and sales tax exemptions on server equipment purchases specifically to attract a data center campus, betting that the long-term economic development benefit outweighs the lost tax revenue. But there's growing pushback in several fast-growing data center markets, because the massive new electricity demand these facilities create often requires expensive grid upgrades, new transmission lines, sometimes entirely new power plants, and in many regulated markets, those infrastructure costs get spread across the entire ratepayer base, including ordinary households, rather than being fully absorbed by the data center operator alone. This has become a real point of friction in states like Virginia and Georgia, where residential electricity bills have drawn direct scrutiny tied to the pace of new data center construction in the region. A facility that pays no property tax for 20 years while indirectly raising its neighbors' power bills is a very different community relationship than the good corporate citizen story the industry likes to tell, and it's a risk factor that sophisticated operators increasingly have to manage as carefully as the engineering itself. Here's where the revenue model gets interesting, because it works completely differently depending on which type of data center you're running. In the colocation model, customers pay based on how much power and space they use, typically priced per kilowatt of committed power capacity per month, along with separate fees for cross-connects, meaning the physical network cables that let one company's servers talk directly to another company's servers inside the same building, which turns out to be an unexpectedly lucrative business on its own, since companies pay a premium simply to be physically close to specific network partners, cloud providers, or financial exchanges. In the wholesale model, a single large tenant signs a long-term lease, often 10 to 15 years, for a dedicated, enormous block of space and power, functioning much more like a real estate lease than a service contract. This is where data center economics start to resemble something closer to the nuclear power plant model from an earlier video in this series. Signing a 15-year lease with a company like Microsoft or Amazon for a dedicated data hall is close to the most stable, bond-like revenue an operator can secure, precisely because the tenant themselves is one of the most credit-worthy companies on the planet, and precisely because moving that much infrastructure once it's built and operational is enormously disruptive and expensive for the tenant to ever actually do. But here's the trap sitting underneath all of this, and it's worth spending real time on because it is the single most important structural risk in this entire industry. That demand story, the one that sounds completely bulletproof right now given the AI boom, has looked exactly this certain before, and it has gone spectacularly wrong at least once already. During the dot-com boom of the late 1990s, a wave of companies raised enormous amounts of money to build data centers in anticipation of internet traffic that everyone assumed would keep growing exponentially forever. Exodus Communications was one of the largest and most prominent of these companies, building massive data center campuses across the country, signing marquee customers, and becoming a symbol of the entire dot-com infrastructure boom. When the internet bubble collapsed in 2000 and 2001, a huge portion of Exodus's own customer base, the dot-com companies renting space in its buildings, went out of business simultaneously, evaporating a massive chunk of expected revenue almost overnight. Exodus Communications filed for Chapter 11 bankruptcy in September 2001, despite having built some of the most advanced data center infrastructure in the country at the time, and was ultimately sold off in pieces. The buildings were real. The technology was sound. The demand simply didn't arrive on the timeline everyone had financed against, and an entire wave of data center capacity built during that boom sat partially empty for years afterward. Here's the thing that should make this history lesson feel urgent rather than academic. The current AI-driven data center boom shares a specific financial structure with that earlier era that's worth understanding directly. A number of newer companies building AI-focused data center capacity have financed rapid expansion using debt secured in part against the value of their computing hardware itself, essentially borrowing against the assumed future value of chips that, as we already covered, depreciate faster than almost any other physical asset in modern industry. If demand for AI compute grows exactly as fast as projected, this financing structure works beautifully, because the debt gets serviced by real contracted revenue from real customers. If demand growth merely slows down, rather than actually reversing, some of these highly leveraged build-outs could face exactly the kind of mismatch between construction debt and realized revenue that sank Exodus a generation earlier, just with newer technology and a different set of company names attached to it. Let's build the two honest scenarios for today's market, because the gap between them explains almost everything about how to evaluate this industry as an investor or an operator. In a good year, a data center operator has locked in long-term leases with credit-worthy hyperscale tenants at close to full occupancy, secured power interconnection well ahead of when it was actually needed, and runs an efficient enough PUE that electricity costs stay predictable and manageable. Revenue on a large wholesale facility might run somewhere in the range of $200 to $400 million annually, with operating margins in the range of 50 to 60% once you strip out electricity pass-through costs, which are often billed directly to the tenant rather than absorbed by the operator, producing extremely stable, highly predictable cash flow for the length of that lease. In a bad year, a facility gets built speculatively, betting that demand will arrive before the leases are signed, and that demand doesn't show up on schedule, exactly the scenario Exodus Communications lived through. Or a facility built for one generation of computing hardware becomes obsolete faster than expected, because a new generation of AI chips requires liquid cooling the building was never designed for, and retrofitting costs eat into years of expected profit. Or the power interconnection that was supposed to take 18 months takes 4 years instead, leaving a fully built, fully financed facility sitting empty and generating zero revenue while debt service continues regardless. Or local political pressure over water usage or rising residential electricity rates delays or blocks a planned expansion entirely, forcing an operator to walk away from land and permitting costs already sunk into a project. On a project financed with the kind of leverage common in this industry, even a 12 to 18-month delay in getting either power or tenants can turn a well-designed facility into a serious financial problem, because the building itself was never really the risk. The timing was. Now here's the twist that explains why some of the most sophisticated investors in the world, sovereign wealth funds, pension funds, and private equity giants, have poured unprecedented amounts of capital into data centers over the past several years. Much like the nuclear power industry we covered earlier, and much like the casino real estate we walked through in another video in this series, data center ownership has increasingly split into two distinct roles. Real estate investment trusts like Digital Realty and Equinix own and operate the physical buildings, power infrastructure, and cooling systems, collecting long-term, largely inflation-protected rental income from hyperscale tenants, while the tenants themselves, the cloud companies and AI labs, take on the far riskier and faster-moving bet of predicting exactly how much compute demand they'll actually need years down the road. The real estate owner gets something close to a long-duration bond backed by some of the most creditworthy tenants on the planet. The tenant gets the flexibility and speed of leasing instead of building, without carrying the multi-year construction and interconnection risk themselves. This is precisely why data center rights have become one of the most sought-after categories of commercial real estate over the past decade, because for an investor able to secure the right tenant on the right lease term, this looks less like a technology business and more like owning a toll road that computing traffic has no choice but to drive across. There's one more layer of this worth understanding, because it's specific to the current moment in a way the earlier dot-com boom never had to deal with. Because AI compute demand is so tightly concentrated among a small handful of extremely well-capitalized companies, the credit quality of your tenant matters more in this industry than in almost any other category of commercial real estate. A lease from a company with a top-tier credit rating and decades of cash flow behind it is a fundamentally different asset than a lease from a fast-growing but still unprofitable AI startup burning through venture capital, even if both tenants are paying an identical monthly rent today. Sophisticated data center investors spend enormous effort underwriting exactly this distinction, because a building is only as stable as the weakest link in the chain of who's actually paying to occupy it for the next 15 years. What separates the data center operators who build generational wealth from the ones who repeat the Exodus communications story is almost never the technology itself, since the servers and cooling systems are broadly available to anyone with enough capital. What actually determines the outcome is whether the facility was built against contracted demand or speculative demand, whether power and water access were secured before or after the money was already spent on construction, whether the tenant behind that revenue can actually be trusted to pay for the next decade and a half, and whether the ownership structure separated the stable real estate risk from the faster-moving technology risk instead of betting an entire multi-billion-dollar campus on a demand curve that, historically, has proven far less certain than it looked at the time. The Internet's need for computing power really has only gone in one direction for 30 years running. Whether any single building profits from that trend, or gets caught financing the wrong 3 years of it, is an entirely different question.